Hey dudes and duderinas, this is the Finance Dude. As already explained in the past 2 videos of the Finance Dude's method, which you can find at the top right, this method consists of 3 steps. The first is the analysis 1.0, the second is the analysis 2.0, and the last one is called the endless analysis. To conclude this extensive review of the analysis procedures, I will now present the endless analysis. After analysis 1.0 and 2.0, I hope to have gathered a group of great companies, ones I will buy because they are at the right price, the others I will keep on my watchlist and patiently wait for the price to reach my investment range. Although I am a long-term investor who loves the compounding effect of my investments, I can't solely rely on a 10-year-old analysis and assume that everything will remain the same forever. I need to incorporate new information constantly. Things change. Businesses change, products change, consumer preferences change, management changes, industry trends change, technology changes, and competitors change. A lot can happen in 10 years. 10 years ago, at the beginning of 2012, ExxonMobil was the second most valuable American company, IBM was the fourth, Chevron the fifth, General Electric the sixth, and AT&T the 10th, all in the top 10. Today, in February 2023, ExxonMobil is the 12th, Chevron is the 18th, AT&T the 50th, IBM the 64th, and General Electric the 85th. Not even one of these all-powerful 2012 companies come in the top 10 in the beginning of 2023. How many people would have said that AT&T would go from 10th to 50th? And IBM from 4th to 64th? And what about ExxonMobil?
Anyone would have said that in 10 years, the second biggest American company would still have the same market cap?
And this is after the huge rise in oil prices, and subsequently in oil companies' profits and their share price. Otherwise, things would look even worse for the 2 oil companies. In 2012, only a handful of people envisioned another future, and one of them was Elon Musk. Tesla disrupted a whole industry, forcing all car makers to go electric or face bankruptcy.
Through accelerating the transition to sustainable energy, it's even threatening legacy companies from other industries such as ExxonMobil, even though it's not exclusively Tesla's fault or that Exxon will even go under.
As we see in the current conflict between Russia and Ukraine, we are still massively dependent on oil.
Additionally, gas is only a fraction of Exxon's profits, and it has other activities that produce massive amounts of yearly cash flows that can help the company to change its course towards a more sustainable activity. Does this mean that we should invest in Tesla now?
I don't know. I must analyze the company. That Tesla is a wonderful company with amazing cars is unquestionable. But is it at the right price? Can other legacy companies threaten Tesla's business? Can Tesla grow to its current valuation? You can argue that in these 10 years, many tech companies turned out to become behemoths. It's true, and a significant number of legacy companies continued to grow but were overtaken by the tech industry. I don't deny that.
But as I already mentioned above, ExxonMobil's market cap went nowhere in 10 years. IBM went from a market cap of around $241 billion to a market cap of $118 billion, and General Electric from $211 billion to a market cap of $91 billion, less than half. Our money would have lost half of its value in 10 years.
What will happen in the next 10 years? Will the current top 10 be the same?
I am a big advocate of dollar cost averaging, but it only makes sense to do it in great businesses, at the right price, and that I am confident will succeed in the longer run, not in dying businesses or industries.
Otherwise, we would dollar cost average to zero. Finally, I can also use this analysis method to review companies I first thought were an A. Companies change, and as they can change for the worse, they can also change for the better. That's why I want to keep an eye on the highest possible number of companies.
And I count on you to suggest amazing companies for this analysis. I also count on you to suggest this channel to that friend or family member that likes to invest in stocks. Having determined the importance of continuously evaluating the companies on our watchlist, I want to confirm regularly that my thesis about the business continues to be true.
Let's now move on to the different steps I take in this analysis. This endless analysis will start by taking a look to the last quarterly earnings the company reported. In this section, I will also look at other important metrics, such as the revenue segmentation and its quarterly trends, and industry-specific metrics such as daily active users or monthly active users for the social network industry, or non-performing loans, CET1 ratio, and forbearances for the banking industry. After the review of the quarterly financial statements and other metrics, I will assess the company's rating with the awesome 5 dimensions method. I will update the financial information and monitor the trends on these pillars. There are many questions to be answered, such as, Are the solvency ratios and its ability to pay down debt deteriorating or improving? Is the company becoming attractive from a valuation standpoint? Is this an opportunity to finally buy that great business we've been monitoring for months or years? Is the growth declining at a faster pace than we thought? Or is it adding even more growth? Is the company becoming more profitable? Or is the cost of doing business deteriorating its margins? Is the company starting to pay a juicy dividend or a generous buyback program?
Or is it cutting its dividends and issuing tons of new shares, diluting the shareholders?
The goal of this analysis is to answer all these questions. Of course, I will not make any investment decision based on the analysis of a single quarter. Sometimes bad quarters happen, and nothing will fundamentally change. What we need to assess are the trends of several quarters in a row, trends that are fundamentally changing or affecting the businesses. This complete set of metrics and ratios will help detect that.
I will also detect those of you who don't subscribe to the channel and hit the like button. Obviously, a quarterly financial results review wouldn't be complete without an analysis of the earnings call, management's takeaways on the upcoming challenges and opportunities, and their statements on guidance and strategy for the forthcoming future.
As I explained in the Analysis 2.0 video, these are crucial steps that allow us to answer any questions we may have about a business. Perhaps that question that was blocking our investment decision,
or an answer to a question that raised concerns about the company's ability to continue delivering,
or also bring a whole new set of questions and more confusion. Through monitoring the management's words, we can also follow up on the list of risks we uncovered in Analysis 2.0. The continuous scrutiny of the risks we face is essential for managing the risk we expose ourselves. As mentioned before, things change. Every day, infinite variables change the world we live in. Even more in the technological era we live in. Every year, thousands of innovations appear. Innovations that might bring additional growth or be the destroyers of our business. And I want to be on top of it as much as I can. After incorporating all the new information learned in this analysis, I am in condition to keep testing the assumptions of my DCF valuation model. Did something significant happen and change my assumptions? Given the new information incorporated, will I need to update the free cash flow growth, free cash flow margin, or shares outstanding change assumptions? Or even the price to free cash flow multiple? Even though this assumption is more rigid, sometimes it might need to be re-rated. If a company expects a lot of growth and profitability in the upcoming years, I might be okay to pay a higher multiple for this business. The contrary is also true. If a company expects lower growth and profitability, we may want to re-rate the multiple we want to pay for the business. I will also keep the same 5 scenarios: base case, bull case, bear case, extreme bull case, and extreme bear case. I will then compare these new results with the previous analysis results in the stock's current price. If the conclusion is that my investment starts to look way overvalued, maybe I will trim the investment or even sell it entirely, realizing those juicy profits we all look for. The truth is that the stock may have appreciated in a single year what I had anticipated for several years, and there's little to no room for additional profits. Or the risk-reward trade-off starts to look unfavorable. If this is the case and nothing has changed in the business model, we should expect an underperformance compared to other businesses in the market as a whole. In these circumstances, I prefer to allocate my money to an asset with higher expected returns. After the revised DCF valuation, I will review the multiple valuation. To assess where a company stands in terms of valuation, I find this simple method really valuable when combined with the DCF valuation. Even though I am a long-term investor, and when I buy a business, I expect to own it forever, the truth is companies change, and the world changes. As such, I want to stay on top of my investments and continuously assess and challenge their value. I also want to be on top of the great businesses I want to invest in, but they were too expensive at the time of the previous valuation. This endless analysis is key to my investment approach, and I want to share one of the most complete analysis methods out there with you. I want you to benefit from this, as it is my purpose to improve the world's financial literacy and help real lives to get out of the rat's race, out of the debt trap, and out of castles in the air storytellers. However, it gives me a great deal of work to keep it running. If you resonate with this investment style and want to be a part of this community of intelligent investors, please consider following the Finance Dude on social media, subscribing to the channel, turning the bell on, hitting the like button, and sharing with your friends and family who would benefit from following this channel. You can also increase your support by subscribing to the Patreon page. The link is in the description. It would help the channel a lot and the dude would be forever grateful to you. The plan in the near future is to make at least 3 weekly analysis.
The ultimate goal is to do a daily research on one Russell 3000 company and one Stocks Europe 600 company, finding all those hidden gems together.
As you can see, this is a pretty ambitious goal. It has 3 tiers with several perks each, such as access to my Discord channel where I want to gather like-minded investors that discuss the daily news and the best stocks to invest in, a special Valuation Excel file where you can make your own assumptions and analyze the stocks you want, access to the exclusive monthly Q&A where I answer to any questions you may have, follow my portfolio and my trades, access to exclusive research papers of each of the stocks that are analyzed here in YouTube, and many other Excel files that will help you in your financial journey. My goal is to add more content as time goes by. They are very rich in content, and your support would help the channel to be more sustainable and improve its quality. It would allow me to focus on the channel's content and provide more analysis, videos, and better content. I also intend to develop some investment and financial management courses that will create value for the community. It's a massive enterprise, but with your help, we will reach even more people.
Together, we can transform the world by giving people proper tools, which should have been given to us all at school rather than kept hidden just for the elites.
The dude is always at your service. Let's go.